market since August.
Second.
Good afternoon viewers, I am Kushal Dattani. Today's topic of discussion is investment banks and security analysts. An investment bank is a special type of financial institution that help companies access capital markets. Typical activities of an investment bank includes raising equity and debt capital, launching new derivative products like the credit debt obligations, credit default swaps, asset-backed securities and the mortgage-backed securities, engaging in proprietary trading with in-house money managers, acting as underwriters and in setting up of mergers and acquisition deals. In recent time, there are three fundamental problems that have been figured out with the investment banking model. First, the inability to correctly predict risks, in this case the risk of default. The second problem is leverage, that is debt financing. The more money borrowed, the worse the consequences of an investment can be. The third problem relates to complexity of these financial instruments created by these firms. Whenever there is a problem in one area of the banking system, it quickly threatens all other areas. As can be seen in the graph, the number of problem institutions have grown dramatically from 2006 to 2009. In the race of investments, the investment banks are closely assisted by security and financial analysts in conducting their research. For more on security analysts, Fahad Saleh reports on the impact of them in the markets.
Thank you, Kushal. Security analysts generally fall into three categories that are buy-side analyst, sell-side analyst, and independent analyst. Buy-side analysts help decide which stocks the institution investors, such as pension funds and mutual funds, hire. Their recommendations are not made public and are only seen and used within the institution who hired them. Whereas sell-side analysts work for broker-dealers and investment banks. These analyst recommendations are made public in the hope that they will generate enough interest in a security and that their firm will generate trading commissions or underwriting businesses. Independent analyst works for firms who sell their research to sell-side and or buy-side firms, but who do not engage in security transactions. Usually analysts who are very well reputed for their research can have a major impact on investor reactions in the market. Like for example, when Meredith Whitney, an analyst of CIBC, downgraded Citigroup while almost every other analyst thought it was large enough to survive through the mortgage industry crisis, shocked the market by reducing the share price of Citigroup by 8%. And this caused $369 billion of decrease in the US stock market value.
With Citi, that was the easiest call of the past year because this was before a lot of the CDO write-downs. So what happened in the third quarter was a lot of the financials took levered lending write-downs, right? So we didn't know about the CDO write-downs. But what you did know about Citi was they'd gone through a massive acquisition spree for about 2 years without growing their capital base.
But in the past few years, it has been the sell-side analysts, particularly, that have been under scrutiny and involved in a number of fraud cases. Recently, analysts working at investment banks have been involved in conflict of interest between the research and investment banking. One of the most well-known cases is the billion-dollar conflict of interest settlement against 10 of the United States top investment firms, as shown here. This was caused due to the fact that investment banking and the analysis departments of these firms had engaged in actions and practices that had allowed the inappropriate influence of their research analysts by their investment bankers seeking lucrative fees. Two of the firms, Solomon Smith Barney and Credit Suisse, were both fined $400 million and $200 million, each respectively, due to the fact that they were alleged to have engaged in inappropriate involvement in the initial public offerings and issuance of fraudulent research reports in violation of the Securities Exchange Act of 1934.
On Friday, April 16, 2010, America's Securities and Exchange Commission filed civil charges against Goldman Sachs for allegedly defrauding investors by failing to disclose vital information about a financial product. Once again, the instrument used by Goldman was synthetic credit debt obligation whose performance was tied to that of the residential mortgage-backed securities. And the person engaged in this trade with Goldman is none other than John Paulson, who had bet heavily against the mortgage market bonds during 2006-2008 crisis through trading of credit default swaps and made a whopping $4 billion bonus for himself. Former Federal Reserve Chairman Alan Greenspan once said, "Credit default swaps was a major financial innovation in the global spread of US credit risk and increases the risk of entire financial system of anti-toughness." In this picture, we can see the growth of financial products, specifically the credit default swaps from 2005 to 2008. Nothing could be more worse at this time when Goldman Sachs still declares and affords to pay £3.5 billion bonus to its staff for just 3 months of work. Goldman Sachs is not the only one betting on derivatives. Recently, in the Greek crisis, we also saw Credit Suisse, JP Morgan and Deutsche Bank, and this has spread all over Europe. Such trades have catastrophic consequences on the economy, like stifling of business, higher interest rates, currency collapse, spending cuts and higher taxes. With banks in the US closing faster than at any time since the Great Depression and the executives still receiving huge bonuses, taxpayers are questioning if their tax dollars were well spent on the bailouts. So, can we assume that current investment banking model needs a big overhaul, with prominent features being transparency, liquidity and increased oversight? The key growth will come only with customer-focused financial product innovation that helps clients identify and manage risk. Therefore, in the recent era of credit tsunami, the question that still remains is, who will be next?